Welcome to the Russell Investments Market Week in Review for the week ending January 28th, 2022. My name is Ryan Pogajemski, and I'm joined today by our Director of Investment Strategies, Shay Shatria. Shay, thanks for being with us here today.
Hi, Ryan. Thanks for having me.
Absolutely. Well, really happy you could join us here after what was a fairly busy week this week in terms of both economic data and market activity. But thought we could focus our discussion today on two of the main areas investors turned their attention to this week, which was number one, an update on some of the news coming out of global central banks. And then number two, some of the continued volatility we saw within the equity markets. Does that work for you?
Sounds good.
Perfect. So, starting with the central bank update, obviously, Shay, in the U.S., all eyes are turned on the Federal Reserve this week with their meetings and comments on Wednesday with investors looking for an indication on what some of their coming actions might be. While from a more global perspective, the Bank of Canada released their most recent policy decisions as well. So, want to get your takeaways from some of this week's meetings and what some of the main messages communicated to investors were.
There were a lot of similarities between both the Fed and the BoC, as we'll kind of discuss. So, starting with the Fed, which is, of course, the most sort of important and consequential for global markets, with regards to their policy decision, there wasn't too much of a surprise. They kept their interest rate unchanged at 0.25%. And they did communicate, however, that rate hikes are forthcoming. We know inflation is an issue, and that's what's been on top of mind for most central banks. So rate hikes are forthcoming, and it does seem like they're gearing up the markets for a March rate hike. Now, March is interesting, which is also their next meeting, because what they've previously communicated is they do expect their quantitative easing program, their asset purchase program, to end in March. So we have a couple of things that'll likely be going on potentially in the March timeframe. Of course, barring any unforeseen circumstances that might change the course of what they're currently projecting. Now, that was all kind of expected. I think where things got interesting as it relates to to this week's announcement was at the press conference itself, where some of the comments were interpreted as a little bit more hawkish, particularly from Chairman Powell. He talked about so far the current recovery being much stronger than it had been in 2015, which was the last time they embarked on a rate hiking cycle. Powell also revised up his inflation forecast, which of course can be deemed as a bit more hawkish. So some of the comments that were made at the press conference were hawkish and interpreted as such, but he did try to balance those out, and did talk about how risks are indeed two-sided. So they do have to be mindful of that, and that requires the Fed to be a bit more nimble and humble as it relates to their interest rate and policy decisions more broadly going forward. Our view is that, as we said, March seems likely, again, barring some unknown or unforeseen circumstance, and possibly June thereafter. But the markets overall are pricing five rate hikes. Now, if inflation is sticky, indeed, that's an outcome that could occur. But our view right now is that inflation moderates over the second half of the year. And that might take a bit of the pressure off from the current aggressive Fed pricing. So it takes a bit of the pressure off from the Fed if inflation does indeed moderate. Now, quickly switching to the Bank of Canada, there were a lot of similarities with what the Fed said. The Bank of Canada, like the Fed, did not hike rates. They kept it at 0.25%. But they were a little bit more explicit in their policy announcement that they no longer believe it's necessary to keep rates at the effective lower bound, and that therefore rate hikes are coming, and that makes rate hikes in March highly likely in Canada. Also, again, barring some unforeseen circumstance. Now, the outlook for the Bank of Canada is also similar to the Fed. The markets are pricing in about five of rate hikes. And similarly, we think that if inflation does moderate over the second half of the year, like the Fed, that would also take the pressure off the Bank of Canada to be as hawkish as perhaps the current market pricing is. So, the key takeaway from our perspective is both the BoC and the Fed, at the end of the day, they will be data dependent. And although market pricing is aggressive, if inflation does indeed moderate, kind of how we expect it to over the second half of the year, then that could take a bit of the pressure off of both of the central banks. But clearly, inflation and data dependency will be crucial going forward.
Sure. No, that's great. Thanks for that summary, Shay. And certainly have to keep an eye on again how that rate path and expectations evolve as we get further into 2022 here. But if we move over towards the equity side of things now and market performance and kind of what market reaction was to some of these events, after a relatively smooth 2021 last year, so far this week, markets had one of the most volatile weeks that they've seen in a while, with some pretty dramatic swings from day to day. So curious to see, again, what the market reaction was to this week's economic news, and also what some of the areas most impacted were.
Yeah, for sure. Yeah, the markets have clearly been volatile this week and year to date, and there are probably several reasons that are just contributing to some of the anxiety and uncertainty in the markets right now. For one, we know the not only the U.S. economy but the global economy will have a bit of a hiccup over the first quarter due to Omicron. So just the macro there is probably having an effect. Geopolitical tensions are front and center right now with the conflict between Russia and Ukraine. Obviously, that has broader implications for energy prices, but also for the economies in that region overall. So, that situation is obviously very fluid and something to keep an eye on. But perhaps the bigger issue is probably what we just talked about, and that's the central banks, and particularly the markets reacting now to a more aggressive Fed rate hiking cycle. And what that has done from a yield perspective, bond yield perspective, we've seen Treasury yields rise from their December lows to where they are currently, and that has clearly had an effect on the markets overall. Speculative technology, particularly because as interest rates move higher. Some of the more growth oriented technology companies, their cash flow profile is a bit further out in the future. So from that discounted mechanism, as their valuations are readjusted lower, that has an impact on their pricing, and we've seen that kind of exhibited in a little bit more volatility on some of the more speculative technology names. So just to give you an example, if we look at some of the market performance so far this year, the S&P 500 index, the broad market's down about 8.5%, versus the Nasdaq 100, which is more technology oriented, is down about 13.5%. And we've also seen some differences in style performances, where the Russell 1000 Value Index, which as the name would suggest, more value and has less technology, has outperformed the Russell 1000 by about 5%. And conversely, the Russell 1000 Growth Index, which has a bit more of a technology orientation, has actually underperformed the Russell 1000 by about 4%. So you could see a pretty big spread in relative performance between value and growth, just like what we're seeing between the broad market and perhaps like the Nasdaq 100, as we talked about. Our view more broadly has been and has had us leaning more towards the value factor, and it does seem like fundamentals are clearly mattering more these days, and the markets are becoming a little bit more discriminating than they were perhaps prior year, and that's not necessarily a bad thing.
Absolutely. Well, thanks for that breakdown, Shay, and really interesting to see again how different parts of the market have been affected a bit differently by some of the different factors we're seeing driving returns out there currently. So thank you for that. So thank you, again, Shay, obviously for joining us for this week's edition of Market Week in Review and for the great perspective on this week's market events. It is all the time that we have for this week, but we'd like to thank everyone for joining again for another week of Market Week in Review, and look forward to speaking with everyone again next week.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.